Are you preparing for the NMLS SAFE mortgage loan exam and looking for an effective way to master key concepts? In this video, we'll dive into the top 200 NMLS mortgage loan exam flashcards to help you confidently tackle the test. From federal mortgage laws to ethical practices, these flashcards cover everything you need to know. Let's get started.
Depreciation, in simple terms, it is the loss in value of a property over time. As per textbook definition, depreciation is a decrease in the value of a property due to wear and tear or market conditions.
Disclosure. In simple terms, it is telling borrowers important details about their loan. As per textbook definition, disclosure is the act of providing information about a loan or financial product to a borrower.
Down payment, in simple terms, it is the money you pay at the start when buying a home. As per textbook definition, down payment is the amount of money paid upfront when purchasing a property.
DTI. In simple terms, it is the percentage of your monthly income that goes toward paying debts, helping lenders decide if you can afford a loan. As per textbook definition, DTI is debt-to-income ratio is a financial measure that compares an individual's monthly debt payments to their gross monthly income, used by lenders to assess a borrower's ability to manage monthly payments and repay debts.
Due diligence, in simple terms, it is carefully checking all details before making a financial decision. As per textbook definition, due diligence is the process of thoroughly investigating a potential investment or transaction.
Earnest money. In simple terms, it is money you put down to show you're serious about buying a home. As per textbook definition, earnest money is a deposit made by a buyer to show good faith when entering into a purchase agreement.
Earnest money deposit. In simple terms, it is money you put down to show you're serious about buying a home. As per textbook definition, earnest money deposit is a deposit made by a buyer to show good faith when entering into a purchase agreement.
Easement. In simple terms, it is permission to use someone else's property for a specific reason. As per textbook definition, easement is the right to use another person's land for a specific purpose.
ECOA, in simple terms, it is a law that ensures everyone gets a fair chance to qualify for loans without discrimination. As per textbook definition, ECOA is the Equal Credit Opportunity Act prohibits discrimination in lending based on race, color, religion, national origin, sex, marital status, age, or receipt of public assistance.
Eminent domain. In simple terms, it is when the government can take your property for public use, but must pay you for it. As per textbook definition, eminent domain is the power of government to acquire private property for public use, typically with compensation to the owner.
Encroachment, in simple terms, it is when part of a building or property crosses over onto someone else's land. As per textbook definition, encroachment is when a structure or other property improvement extends beyond its legal boundaries.
Encumbrance. In simple terms, it is legal limits on what you can do with your property. As per textbook definition, encumbrance is anything that limits the homeowner's ability to use their property freely, including zoning regulations, tax liens, or homeowner association restrictions.
Equity, in simple terms, it is the part of your home's value that you actually own. As per textbook definition, equity is the difference between the market value of a property and the amount owed on its mortgage.
Escrow. In simple terms, it is an account where money is kept safe until it's used for property taxes or insurance payments during your mortgage term. As per textbook definition, Escrow is an account managed by a third party where funds are held temporarily until certain conditions are met in a real estate transaction or for taxes insurance payments during a mortgage term.
Escrow account. In simple terms, it is an account where money is kept safe until it's used for property taxes or insurance payments during your mortgage term. As per textbook definition, escrow account is an account held by a third party to hold money for taxes and insurance.
Fair Credit Reporting Act, FCRA. In simple terms, it is a law ensuring your credit report is fair and accurate. As per textbook definition, Fair Credit Reporting Act, FCRA is a law that promotes accuracy, fairness, and privacy of consumer information contained in the files of consumer reporting agencies.
Fair market value. In simple terms, it is what a home would likely sell for if both buyer and seller are acting fairly. As per textbook definition, fair market value is the estimated price a property would sell for in an open, competitive market under normal conditions.
Fannie Mae. In simple terms, it is a big company that buys home loans from banks to keep money flowing in the mortgage market. As per textbook definition, Fannie Mae is the Federal National Mortgage Association, a government-sponsored enterprise that buys mortgages from lenders.
FCRA. In simple terms, it is a law ensuring your credit report is fair and accurate. As per textbook definition, FCRA is the Fair Credit Reporting Act promotes accuracy, fairness, and privacy of consumer information contained in the files of consumer reporting agencies.
Federal Housing Administration, FHA. In simple terms, it is a government agency that helps people buy homes by insuring their mortgages. As per textbook definition, Federal Housing Administration, FHA, is a government agency that insures mortgages for low to moderate income borrowers.
Federal Reserve. In simple terms, it is the main bank that helps control the economy by setting interest rates. As per textbook definition, Federal Reserve is the central bank of the United States responsible for monetary policy.
FHA loan. In simple terms, it is a government-supported loan with low down payment options for first-time buyers or those with limited credit history. As per textbook definition, FHA loan is a government-backed mortgage insured by the Federal Housing Administration, ideal for first-time buyers due to lower down payment requirements.
FHA mortgage insurance. In simple terms, it is extra insurance you pay on FHA loans to protect the lender. As per textbook definition, FHA mortgage insurance is insurance required on FHA loans to protect lenders against losses if a borrower defaults.
FICO score. In simple terms, it is a number that shows how good you are with credit, used by lenders to decide if you qualify for a loan. As per textbook definition, FICO score is a credit score created by the Fair Isaac Corporation, used by lenders to assess a borrower's creditworthiness.
Fiduciary. In simple terms, it is someone legally bound to act in your best interests, like your real estate agent. As per textbook definition, fiduciary is a person in a position of trust who is obligated to act in the best interest of another party.
Fixed-rate mortgage. In simple terms, it is a mortgage where your monthly payments stay the same because the interest rate doesn't change. As per textbook definition, fixed-rate mortgage is a home loan with an interest rate that remains constant throughout the life of the loan, providing predictable monthly payments.
Forbearance. In simple terms, it is a break from making mortgage payments when you're having money troubles. As per textbook definition, forbearance is a temporary postponement of mortgage payments granted by a lender to a borrower facing financial hardship.
Foreclosure. In simple terms, it is when the bank takes back your house because you didn't keep up with payments on your loan. As per textbook definition, foreclosure is the legal process where lenders take possession of property when borrowers fail to make payments on their mortgage loans as agreed upon in the contract terms.
Freddie Mac, in simple terms, it is another company like Fannie Mae that helps keep the mortgage market running smoothly. As per textbook definition, Freddie Mac is the Federal Home Loan Mortgage Corporation, another government-sponsored enterprise similar to Fannie Mae.
Ginnie Mae. In simple terms, it is a government agency that backs certain mortgage investments to encourage more lending. As per textbook definition, Ginnie Mae is the Government National Mortgage Association, which guarantees investors the timely payment of principal and interest on MBS backed by federally insured or guaranteed loans.
Good faith estimate. In simple terms, it is a list of estimated costs for your home loan provided by the lender upfront. As per textbook definition, good faith estimate is a document provided by lenders that outlines estimated costs associated with a mortgage loan required under RESPA.
Government-sponsored enterprise, GSE. In simple terms, it is a company created by the government to help with financial services like mortgages. As per textbook definition, government-sponsored enterprise, GSE, is a financial institution created by the U.S. government to provide financial services.
Hazard insurance. In simple terms, it is insurance that protects your home from damage due to fires, theft, etc. As per textbook definition, hazard insurance is insurance coverage that compensates the policyholder for property damage caused by hazards such as fire, theft, or vandalism.
HELOC. In simple terms, it is borrow money when you need it using your home's value as a guarantee to pay it back later. As per textbook definition, HELOC is a home equity line of credit, allows homeowners to borrow against their home's equity as needed, similar to a credit card, but secured by the property as collateral.
High-cost mortgage. In simple terms, it is a home loan with very high interest rates or fees that has special rules to protect borrowers. As per textbook definition, high-cost mortgage is a mortgage with interest rates or fees above certain thresholds, subject to additional regulations under HOEPA.
Higher-priced mortgage loan. In simple terms, it is a more expensive mortgage that may have additional rules to follow. As per textbook definition, higher-priced mortgage loan is a mortgage with an annual percentage rate that exceeds the average prime offer rate by a specified amount.
HMDA. In simple terms, it is a law making banks share data about the mortgages they approve or deny. As per textbook definition, HMDA is the Home Mortgage Disclosure Act requires financial institutions to maintain and annually disclose data about home purchases, home improvement, and refinance applications.
HOEPA. In simple terms, it is a law protecting borrowers from unfair practices on high-cost home loans. As per textbook definition, HOEPA is the Home Ownership and Equity Protection Act sets requirements for certain high-cost mortgages, aiming to protect consumers from predatory lending practices.
Home equity. In simple terms, it is the amount your home is worth minus what you still owe on it. As per textbook definition, home equity is the value of a property minus any outstanding mortgage balance.
Home equity line of credit, HELOC. In simple terms, it is borrow money when you need it using your home's value as a guarantee to pay it back later. As per textbook definition, home equity line of credit, HELOC, is a line of credit that uses your home's equity as collateral.
Home inspection, in simple terms, it is a check of your home to find any problems before you buy it. As per textbook definition, home inspection is an examination of a property's condition to identify potential issues.
Homeowners Association, HOA. In simple terms, it is a group that oversees shared spaces in neighborhoods with rules. As per textbook definition, Homeowners Association, HOA, is an organization that manages and maintains common areas in a residential community.
Housing expense ratio. In simple terms, it is how much of your monthly income goes toward housing expenses. As per textbook definition, housing expense ratio is a metric used to determine how much of a borrower's gross monthly income is dedicated to housing costs.
HUD-1 settlement statement. In simple terms, it is a form that lists all the costs when buying or selling a home. As per textbook definition, HUD-1 settlement statement is a document that outlines all costs associated with a real estate transaction.
Interest rate, in simple terms, it is the rate at which you pay interest on borrowed money. As per textbook definition, interest rate is the percentage at which interest is paid on a loan or investment.
Investment property. In simple terms, it is a property bought to earn money through rent or increased value. As per textbook definition, investment property is a property purchased for the purpose of generating income or appreciation.
Jumbo loan, in simple terms, it is a very large home loan that doesn't fit standard guidelines. As per textbook definition, jumbo loan is a mortgage that exceeds the conforming loan limit set by Fannie Mae and Freddie Mac.
Junior lien. In simple terms, it is a second loan on your home that ranks below the first mortgage. As per textbook definition, junior lien is a secondary claim on a property, such as a second mortgage.
Lender, in simple terms, it is a bank or company that gives you money for a mortgage. As per textbook definition, lender is an entity that provides loans to borrowers.
LIBOR. In simple terms, it is a global interest rate that banks used to use as a basis for many loans. As per textbook definition, LIBOR is London Interbank Offered Rate, a benchmark rate that some of the world's leading banks charge each other for short-term loans.
Lien, in simple terms, it is a legal hold on your property until you repay what you owe. As per textbook definition, lien is a legal claim against property as security for debt repayment, must be paid off before selling or refinancing the property.